Welcome to the Nova Wealth Show. I am your host, Amy Novakovich.
And I'm Jim Novakovich. We're a husband and wife team and co-founders of Nova Wealth Management.
We also teach you how to build wealth, advise you how to keep it, and how not to get taken advantage of. So let's get started. Hi, welcome to the Nova Wealth Show. This is Amy and Jim Novakovich. Thank you for joining us today. I think one of the most unsettling feelings is when you know you need to know something, but you're not interested enough to understand. And nobody will take the time to explain it to you. It's super frustrating. And there is an investment class, would you say, or just a type of investment? A type of investment?
Type of investment.
That's out there that is super confusing, that they're sold incorrectly all the time to people that don't need them, and we're going to cover them today. So we're going to talk about structured notes, why you need to know about them, how they make you money, and how they lose you money.
Yeah, good.
Got it?
Yes.
So why don't you, in a nutshell?
Well, let's talk about what a note is first.
Oh, good.
So when you're talking about notes, it's a debt instrument. So if a bank or a company needs to raise capital, they create these structures, and it's a note. A note is simply just
debt.
Debt, like a bond.
Yeah, you're lending money in exchange for an interest rate.
That's it. It's that simple.
Mm-hmm.
So a structured note is now. Let's talk about a typical note or a typical bond is, like you said, company needs money. They borrow your money. They pay you interest.
It's usually fixed.
It's usually a fixed rate. And so say you give them $10,000 for 5 years, and at the end of 5 years, your note matures or comes due, and you get your principal back.
As long as the company is still in business.
Right, which is a very important point.
Right. Very important point on the notes, because there are structured CDs too, which we'll get into, which are FDIC insured. That's why you have to be so careful with this. You have to understand if you're FDIC insured or if you're just backed by the company that's selling it to you, that's giving it to you.
Right. So that's why people typically say bonds are safe, because when they mature, you get your money back. And all along the way, you earned interest. It's that simple.
Right.
So a structured note, should we just get right into the structured note? What else can we lay the groundwork on? Well, we're going to talk about structured.
I'm thinking.
Yeah, we're going to.
My face probably wasn't too pretty there.
Oh,
I was like sitting there
it's
like
always pretty, honey.
Thinking hard. I'm just trying to think about how we can make this as basic as possible, because the structured notes are complicated, as in there's a lot of moving pieces. But bonds in general are not super complicated. All you really need to know is they're going to be safer. They're not going to have return like a stock at all.
It's usually a fixed low interest rate, especially in this rate environment.
I want to clarify something real quick, and this might be making it more complicated, but all bonds, most bonds are issued at $1,000 per bond. They're issued in $1,000 increments, even structures. $1,000 increments. So when it matures, it's issued at $1,000 and it matures at $1,000. You can buy it along the way. You can buy it along the way between the time it was issued and the time it matures. And that's called, if it's above $1,000, it's a premium, and if it's below $1,000, it's a discount. Makes sense, right? So when you say it matures and you get your money back, you get par value back, which is that $1,000 per bond. So if you paid a premium, if you paid $1,100 for the bond, you're getting $1,000 back at maturity. The hope is you make your interest along the way to make back up that extra, $100 per bond that you paid. Right. And if you bought it at a discount, let's say you bought it at $950, and it matures at $1,000, you just made $50 a bond. So I just wanted to clarify that small point.
No, that's a great point.
Because that's how you can lose money too. If you bought it at $1,000 and you sell it at a discount to someone else at $950, you just lost $50 a bond.
Right. So if you wanted to sell it before it matures.
Before maturity.
You could lose money on a bond. Or the other way you could lose money on a bond is if the company files for bankruptcy.
Goes under.
That's your risk with a bond.
Because it's debt. Remember, again, let's define it again. A bond is just debt. So just like you and your credit, if you default on something, they don't get their money. If you stop paying something, you don't get their money. If you file bankruptcy, they don't get their money. So it's the same thing. Okay, so structures. Go over that interest rate.
Oh, I just had a thought. I should have wrote it down. I have this yellow pad of paper here. I should have wrote it down, but I dropped my pen.
That's a pencil, by the way. Jim uses pencils. I don't know why. You're not ancient.
They're mechanical pencils.
Okay.
I like them.
Okay.
Makes me happy.
Whatever. That's what makes you happy.
What else do we have to? What
So
else
that's the basics.
Other
really.
things we could talk about with bonds. So the value goes up and down. I guess maybe we could talk about like a traditional bond. The reason that price will fluctuate, because we talked about the price fluctuating. What makes the price of a bond fluctuate? A typical bond.
Why does it fluctuate?
Right.
Well, you did mention one. Let's say the company is starting to go under. That's going to make the price go down.
Right. Yeah. So
They're slowly going to go under. It's not going to happen like overnight.
although it could,
I guess
we've
it
seen
could.
that. But if a company is trending in the wrong direction, say they have a 10-year bond out there, and 2 years into
you
this
talk about
bond,
that maturity.
2 years into this bond, say things go really bad and the company looks like they're not going to make it. Well, that $1,000 that you paid for that bond 2 years ago,
If you tried to resell it,
it's going to maybe be worth $600 or
Right.
or less
Or
or
less.
more. I mean, it'll be less than 1,000 is the point. If negative news comes out in the company and there's a risk that it could fold,
right?
it's not you're not going to be able to sell it early for $1,000.
So in summary, who are bonds in general for? And we're talking about bonds because we're getting to structured notes, so we're laying the groundwork of how bonds work, because that's essentially, structured note is essentially a type of a bond, really.
Right.
So we're laying some foundation. So bonds are more if you're looking for safety in general over stocks, or if you're looking for income. That's another reason why you own bonds. You're looking for safety, you're looking for income, you're looking for something that's paying you an interest rate. Okay? And then how can it make you money? It pays you interest. Or if you buy the bond at 1,000 and you sell it at 1,100 per bond, you just made $100 per bond. So that can make you money. How do you lose money? You buy it at 1,000, you sell it at 950. You just lost $50 per bond. And this is all before it matures. Maturity date is the day it ends. The day they pay you back $1,000 per bond, and the day the interest stops. That's the maturity date. So, okay, I think we've laid a lot of the groundwork. So let's get into how does a structured note pay interest. And this is the critical part, because this is where it's super confusing when you get told about a structured note. And a lot of times it's from a bank, I feel like. And maybe that's me making an assumption because I worked in a bank. But I just feel like I
think it's a lot of bankers.
Investment bankers are the ones that sell the structures. And I actually like structures.
I do not.
Jim doesn't. And we'll get into the reasons why. But go ahead. You have the
Well, why don't we play a devil's advocate here? Well, we got to explain what it is first.
You gotta say what it is first.
So
you
it's-
like to do that. You like to jump right into the arguing before we even explain why we're arguing.
So, well, that was just you. That's right there. You're picking a fight. You're like poking the bear. Like, let's fight now by saying that.
Poking the beehive.
I'd rather be a bear than a bee.
Okay.
Yeah.
These are very important in society.
Bees are?
Okay,
I know, but they're
yes.
dying. So, anyway. Okay, structured note. So, it's a note, it's a bond, it's debt.
Yes.
If a company wants to raise capital, but in today's rate environment, like right now, I think the 10-year Treasury is at like 2.57, maybe 2.55, something very low.
Interest, 2.5% interest is what he said.
For 10 years. So you give
Every
the
year for
Treasury
10
your
years.
money, and 10 years, though, you'll get your principal back, and along the way, you'll earn 2.55
per year.
per year. So, a structured note. So these companies have to get creative in low interest rate environments. They have to get creative on how they're going to raise capital, and they try to entice you by saying a typical structure would look like this. They're going to give you 10 companies, and those companies might be companies like GE and Verizon.
That's where you're going to start with structures? That's like one of the more complicated ones.
How
I would
so?
start with just they link it to the S&P 500 and they give you a cap.
Why don't you explain how you feel structures are?
I just don't want to confuse people because that is why they're so confusing. Okay,
Go ahead.
The interest rate varies. They're getting creative on how they calculate your interest rate. So instead of just 5% fixed, they might say, for example, take the S&P 500. Let's see how the S&P 500, which is just the market, by the way, let's see how that does over a year, and we'll give you up to 8%. They call that a cap.
How much?
8%.
They're not offering 8% right now.
Okay, but I'm just giving an example.
Well, give a
And
realistic example of today. Don't give 8%.
They might give you 5%. Yeah,
Yeah.
5%.
For how
So
long? 3 years?
No, 1 year. These are structured notes, not fixed annuities, not indexed annuities.
I know it's not a fixed annuity. or an
No,
indexed
so you
annuity.
can find a 1 year cap with 5%.
On the S&P?
Yes. It's probably higher, actually. I will call the company after this.
I don't even want to know. I don't want to know.
So let's say the S&P goes up 20%, you get your cap. Jim's cap is 5. Let's say it's 5.
It's probably no better than 5.
S&P goes up 4%, you get 4. S&P goes down, let's say it's negative 20, you don't lose anything, but you don't make anything.
No. You do lose. You lose.
How?
They'll probably put a buffer on the downside.
No, not in the... Okay. Now you're really getting confusing. I was just trying to simplify what a structured note is, and then you can get into all the different types, honey. A structured note, very simply put, is just they're going to use creative ways to calculate your interest rate.
It's that simple.
It's that simple. Now let me finish my thought. So when the S&P goes down, you would still get your $1,000 per bond back at maturity, but you would earn 0 interest. So that's the risk, is that you forego any interest you could have gotten in like a savings account or a CD or something else.
That would be a good one. A 1 year 5% upside with no downside after
That
a year?
exists, honey. Yes, that exists.
I don't think so.
Yes, it does. And a lot of times I get the ones that are issued by like JP Morgan, the bigger companies. I think BNY Mellon does them too, BNP over in France. So big companies. But it can be done with smaller companies too. HSBC is another one. So you just have to make sure you have a good issuer, because that's who's backing it. Unless it's FDIC insured. In that case, the rate would be even worse. You might be thinking of an FDIC insured one.
No, I'm not. I'm thinking... If they're giving you decent upside,
this is where we argue.
If they're giving you decent upside with no downside,
right?
I'll tell you what. Right now,
5% isn't.
If you find, you go ahead and call your guy.
I will.
And if you can get a 5% 1 year on the S&P point to point, because that's the other thing. There's a lot of funky ways they calculate the return. They can do a monthly average. They can do.
An average each month. How did the S&P, for instance? It doesn't always have to be the S&P, but I use that as an example because a lot of people.
That's a good one to use. Don't use anything else but the S&P.
But they can take the average of how did it perform this month? 2%. How did it perform this month? Down to. How did it perform this month? And they'll average out the 12 months.
Or they'll do a monthly cap where they'll say you could earn up to 2.5% per month, but if it goes down 8% in a month, they count that as your in the calculation as well. So
then, yeah.
Point to point is a critical term you need to know for structures, for indexed annuities, things like that. Point to point is what you're looking for.
Point to point means from the time you get in to the time it matures. So if you have a 3-year note, point to point, they're going to measure that index over 3 years. So keep in mind, over 3 years, I just hit that, sorry if that was loud. The index could go up and then come back down and you end up earning nothing. 3 years is a long time. So I also wouldn't do that. Unless it's a really good cap.
That's what I'm saying. If you could find a 1 year point to point 5% cap with 0 downside risk.
Okay.
With the exception of the company going out of business in a year.
Right.
Which is very, very low.
5% cap. I'm taking this challenge.
You
I'm
go
going
ahead.
To tweet it out. Oh, I didn't say our Twitter handle.
Yeah,
go ahead and follow us on Twitter at Nova Wealth Management, MGMT. Management's abbreviated. And also go to our Facebook. We do a Facebook Live every Friday, and we answer your questions live. And go to our website. We always have additional resources on our website, novawealthmanagement.com. So let's summarize real quick, because I feel like we've been rambling for a while. So when you look at bonds, or when you look at structured notes, as we've been calling them, fixed income is also another term. You generally look at these asset classes because of safety or because of income. In general, you're looking for more safety than the stock market.
Right.
Okay? And then you can make money because they pay you interest. So it's not going to be as much as like what you might make in a stock, but it's a good solid interest. Again, sometimes it's great for income because it's predictable a lot of times. Then you add in structured notes and it's not predictable. So now you've got this safety factor that's not supposed to lose you a lot of money, but you don't have fixed interest. You've got a little more upside than a standard bond, but you still don't have the downside most of the time. How can you lose money? That's what we'll get into now. We'll talk about the buffers, how you can lose money.
Oh, do we have to get in this? I think now would be a good time to just kill it. I think we're good. I think they got the
I think
gist
you need
of
to
it.
mention the buffer.
Well, I think she's
lose
not
money.
going to be able to come back with what she's saying here. There's no way we're getting a 5% upside with 0 downside in 1 year, point to point on the S&P. If we do, everybody who sees
You're
this,
shouting.
everyone who sees this should call us and say, "Put my money in that," and I would
Why?
support that. For safe money?
So somehow we flipped here because I like structures because they offer a piece in between bonds. Bonds offer a fixed interest rate and stocks go up and down. And structures limit your downside and give you a chance at more upside. So they're like right in the middle. So I like that piece. I like them added in. And I've had clients say they're just too complicated for me. It's not my taste.
Well,
and
they
that's
don't
fine.
need to know if they have an advisor they trust. I'm usually against it because I think you're going to come back and say the buffer.
You just don't think they're worth it. You don't think they're worth the little risk that
what
they have.
you're saying is completely worth it.
You get principal protection with an upside of 5.
5% on the S&P for 1 year?
Okay, the buffer. Let's talk about the buffer. And there's 2 types of buffers, okay? So there's a buffer where they say, let's say your buffer is 10%. That means the company that's issuing you the investment, the structured note, will eat the first 10% of the downside. So if the market goes down 30, they eat 10, you still go down 20.
Yeah.
That's
So there is downside in buffered notes.
Well, then there's a second kind of buffer. There's what they call, I think they call it a hard buffer. I don't do these, obviously, but I think they say essentially you'll get knocked out, right? You know, remember the ones that had the upside, the absolute return
Yeah,
ones?
but those are pretty rare.
So for sake of this show, let's
don't
just stick
talk
with the
about
buffer that you can lose and they eat the first 10%.
That's the
of
most
downside.
common.
That's the most common. So you still have risk, right? So you have less risk. They eat the first 10% or first 20% or whatever. They have less risk. You have less risk, but you still need to understand what that means and ask these questions.
So the bottom line is if you
Bottom
get
line, let's
pitched
summarize
a
and wrap it
structured note, more than likely your bank is going to, you know, they'll want you to go see their investment guy, and they mostly do package products, and they may show this to you.
Right.
Ask lots of questions.
Ask, is it FDIC insured? Who's the company that's giving it to me? How can I research the company? Make sure they're financially stable. Do I have a buffer? Is it point to point?
Yeah, get an investment person you trust and who
Get
can
a second
explain these
opinion.
things
I mean,
to
give us
you.
a call. We'll be happy to give you our opinion.
I think the bottom
Honestly.
line is don't ever take anyone's word for it unless you trust them, unless you know them,
Unless you know them, if they've never really steered you wrong, and
or if they were referred to you by someone else who knows them that you trust.
yeah, because I like
Because-
them. I like them for a piece. Like I said, I feel like they make sense when you're trying to diversify. They're a piece that people don't have.
I agree. If it's what you're saying, 5% upside, point to point on the S&P 1 year with no downside.
I'm gonna find that for you.
I don't think you are.
Thank you for watching, and we'll be here next week. Have a great day. Thanks for watching the Nova Wealth Show.
Bye.